Welcome to another episode of the Around the Coin podcast. I'm your host, Stephen Sargeant. Today we have Angie Walker. She's the commercial head of Apex Digital. They've come out with their 3.0 platform that's bringing all asset classes, tokenizing them, bringing them on chain, and making them available pretty much 24/7. This was such an interesting conversation because Angie has such great experience working with R3 in the early days in Corda, working with Chainlinks, and as well as bringing her traditional knowledge to such a complex digital asset space. We cover everything, including real world asset tokenization. We talk about regulation, what's happening with jurisdictions that are now evolving into stablecoins, and their new stablecoin as a service solution that's offering issuers an easy way to do all the back end and administrative processes that's bringing stablecoins into 2026 and beyond. We even get to talk to her about the Apex Invest Summit that they had in September, where they brought some of the biggest industry thought leaders into the space to talk about the future of on-chain assets. This is such a creative episode. Angie's a wealth of knowledge, and you will absolutely be more educated on asset tokenization after listening to this podcast. And she even gave us permission for you to reach out to her directly at Apex Digital. This is a must-watch episode. I hope you enjoy. Welcome to the Around the Coin podcast. Stephen Sargeant, live from Toronto, speaking with Angie Walker. You're the commercial head of Apex Digital. Why don't you tell us a little bit about what your background, Angie? Then we're going to get into everything that's happening in tokenization, stablecoins, digital asset infrastructure. We have a lot to cover in 50 minutes, but I'm excited for you to share the audience your journey up until this point in crypto.
Okay, awesome. Well, it's great to be with you, Stephen, today, and thank you very much for inviting me. So, Angie Walker, I run Apex Digital Commercialization and Business Development globally. I've been with Apex for about 3 months, so it's very early days for me in the world of Apex. Prior to that, I've spent the last 8 years in blockchain and DLT with R3, working on Corda in the very early days of innovation within financial services. From 2018 through to 2023, and then I spent 2 years after that with Chainlink, helping Chainlink to set up their franchise in banking and capital markets. Before all of that, I spent 20 odd years building financial market infrastructures and front office trading platforms globally, primarily around listed equities and listed derivatives, listed securities and derivatives. So spent my whole life in banking and capital markets, trained as a nuclear physicist, decided I didn't like that and moved into financial services, and I've been there ever since. So it's great to meet you.
Awesome. I'm curious. R3 was probably one of the most revolutionary products when it came out, but it was also met by a bunch of bear markets, financial institutions kind of opting in and opting out depending on the volatility of the Bitcoin prices. Can you talk us about the early days? Like, what was the evolution of R3? And then maybe even, touch on where it is today.
Sure. I mean, I won't comment so much about where it is today because I'm not involved directly. But certainly, if you look at R3, I mean, I was there for 6 years. I was probably there for the most exciting period of R3's existence. It was founded by David Rutter and 2 other colleagues, and they raised actually an incredibly large A round, 117 million. Across 42 banks. They had global investors. It was a very impressive cap table they had, and that added massively to the things that we achieved in that period of time. They built originally they weren't sure what they were going to be building. They'd been brought together to try and work out what was blockchain all about, what did it mean to financial services, what could we do with it, was it actually going to have a purpose in our lives. And that was why they raised that money, because they realized very quickly that it was going to be significant, and therefore they believed that they needed to innovate in order to discover what we could use from a regulated market perspective. And about 2 years into that journey, we launched Enterprise Corda, which would have been around the end of 2019. Maybe Enterprise came out. We did an open source version in late 2018, but we went Enterprise in 2019. And we did some amazing projects. So I was very privileged to be in SDX with Six Group in their Six Digital Exchange right from the very beginning, before they even had furniture in the building. We all sat around a sort of a dining room table in the original design phase of SDX. It was very impressive, and I went all the way through that journey, all the way through to when they went live eventually back in 2021. And I was also very fortunate to be involved in the design team and the implementation of the DFMI with Euroclear, the Digital Financial Market Infrastructure with Euroclear, both of which were built on Corda, and both of which exist to this day in a live and production environment. So Corda had a very important role to play. It helped people in the early stages to get to grips with and feel comfortable about decentralized technology, decentralized ledgers. It was a very private and very permissioned ledger, so it was only there for actors and participants that we knew who they were, and you would only be able to interact with any applications on the ecosystem unless you were a known counterparty to that particular group or that particular application or ecosystem. So it had very, very heavy permissioning, it had very, very heavy privacy capabilities, and it was a very secure environment. But it was also, because it was very heavily permissioned and very private, it was also a little bit closed, and so it made it difficult for applications talking inbound into that DLT environment to be able to interoperate easily. It was also built on a platform on a technology called UTXO, which again made it difficult to interact with it if you were building on traditional sort of EVM Ethereum based technology, because those two state models don't interact very easily with each other. So over the 6 years that I was at R3, we did some amazing projects like the Euroclear project with DFMI, like the project we did with SDX, and I was very happy to be involved in all of that. And we did the first ever collateral mobility project with Clearstream and in their D7, their digital environment, with HQLX. We took that live back in 2019, I think it might have been, or 2020. And that was where we took high quality liquid assets in baskets, and we created what was called a digital collateral receipt that pointed back to the underlying basket, which was lodged with the custodians. And the custodians, when we took that live, were Clearstream and Euroclear. And then they obviously expanded the custodian population out, and they also expanded the number of banks that were participants within that ecosystem. So I think they've now got a very impressive group of banks that exchange, downgrade and upgrade collateral in real time via the Eurex repo market, using these digital collateral receipts. So there's some of that very early innovation was very important, because although we're less interested in private permissioned ledgers today, actually it helped us to prove out some of the use cases that are now really starting to gain momentum in the current world. So it had a very important role to play, even though as a technology platform, it's now pretty much come to the end of its life.
Is it funny to kind of look back then and then seeing the the financial institutions that are entering the space now and kind of toting this innovation flag when you're like, we were doing this like 8 years ago? Is it kind of funny to see the evolution of the industry and to see more traditional institutions finally getting into crypto and going all the way now into like staking on Solana and these more DeFi related projects?
So no, it probably isn't. The reality of the situation was the technology was never the thing that held back the adoption. It was the regulatory landscape and people's appetite to want to take things into production off the back of that regulatory landscape. So I think the technology itself has been very mature for a number of years. I'd certainly say since 2019, 2020, both private permissioned and public permissioned chains have been in reasonably good shape. They're very secure, they're very scalable, they're robust. So I think we've had a good 4 to 5 years where the technology hasn't been the limiting factor. I think the regulatory landscape has been very asymmetric, and that has made it very complicated to launch with scale some of these use cases across jurisdictions. And I think the really big limiting factor was the lack of cash on chain. And obviously, as we move towards licensed stable coins, and we're able to put digital money onto the chain in the form of a stable coin, and in some jurisdictions in the form of tokenized deposits and CDBC, I think the ability to now facilitate the movement of the cash as well as the movement of the asset has enabled these production grade use cases to start to gain momentum. But without the cash, it was very difficult, because all of that would then have to be facilitated as an off-chain workflow.
I'm curious, you've launched Apex Digital 3.0, which is really bridging that gap between what you're just explaining, right? The traditional players that have been on the sidelines, and now they're coming into the asset tokenization and being able to do it at scale. What is the gap that you and your team saw in the industry, especially when it comes to RWA, real world asset tokenization, that allowed you to fill this gap with Digital 3.0?
Yeah, so I guess it happened or it evolved in a slightly different way. So if you think about Apex's heritage, they are, getting close to 4 trillion of assets under administration. They've always been very dominant in the private market space, and so they've been providing for over 20 years now to transfer agency, fund administration, corporate services, Manco, and they've even got a bank in Luxembourg. So they've got a very, very extensive and very well matured operate model around the fund administration space. Got over 10,000 customers. So if you think about that engine room, that's a lot of capabilities that were already incredibly well established. They're the biggest independent TA in the world, basically. And what we were able to do is effectively think about it almost like an uplift. We've uplifted that service. So we are in a very, very fortunate place in that we were able to layer on top of all of that the ability to tokenize assets and then continue the journey of that life cycle using our existing transfer agency and fund administration. So the tokenization, which is at the front of that process, primarily around the representation of the asset in a digital form natively, or potentially a representation of a record of the asset in the digital form, effectively precedes all of the other service lines that we have today. So we've launched Apex Digital. We're able to tokenize share classes within a fund. We're able to tokenize entire funds. We already provide and have done for 10 years asset servicing for fund servicing for crypto funds, for example. We've been doing that for 12 years already. We've been providing middle office and treasury functions and reporting for stablecoins for about 2 or 3 years. We just don't tell anybody about it. So we've uplifted that as well. And so where we are today is we're effectively, as of the beginning of next year, we're going live with a 24/7 operate model and a support model for all of our fund servicing business in the tokenized form. And why that's important is if you look at where the market's going, the market is going towards this ability to be able to subscribe and redeem potentially in near real time or real time. And that's very relevant when you start to think about things like money market funds. So if you're tokenizing a money market fund, you've got to be able to have a subscription and redemption cycle that has a very high velocity, because the people who are investing in those funds have an expectation. They want to be able to get in and out of those funds in real time. So what we've done is we've taken very well industrialized operate model within Apex, and we've lifted it up so that we can actually now run that operate model 24/7 from a TA perspective, and we can support that from a fund administration perspective on a real-time basis. So we're constantly monitoring the assets that back these tokenization, these money market funds, tokenized money market funds, to make sure that everything is in sync with respect to the custody of the assets versus the actual tokens that exist on the chain. So, and the same applies for stablecoins. We launched our stablecoin as a service offering recently, and again, we're running that same 24/7, 365 model, including the on-ramp and the off-ramp to fiat for stablecoins that we are running for money market funds. So I think what we've been able to do is take what is a very established operate model and a very established global footprint of regulation. We're licensed in 50 countries. We've got TA licenses in 36 of those already. And so we operate on a global basis, and we've been able to lift that and extend those licenses into digital TA licenses in many of those jurisdictions to be able to offer a end-to-end digital service on top of the pre-existing service offerings. So it's put us into a very unique position where we can go to any of our clients today and we can offer a full end-to-end tokenized fund service offering.
What's the most common use case? Like, who's the customer that's going to be banging down the door that's already using your services, that were like been dying for this tokenization and the ability to operate 24/7, which is, many in the financial products, maybe not the traders, but that's their dream, is to be able to access the markets on a 24/7 basis. And then, the end of the trading day is usually what is needed for a reset. What happens when we get into a 24/7 nature and there's not that end of a day and everything's constantly happening? Is there any side effects or challenges with that?
Yeah, so to answer your first question, Stephen, the customers are a combination of existing Apex customers who want to start their own digital journeys, and that's very, very that's a very significant community of people. I mean, Apex has got a huge customer base. It's got about 10,000 customers globally. But the point is, what's happening is the market shifting. So if you actually look at the traditional market, it was, a lot of the investments were sat around the securities market, a combination of equities and bonds, for example. And if you look at there's a shift away from that ratio, much more towards private markets. So typically the holdings in private markets in the wealth sector were relatively small. They recognize the demand of their investors means that they have to uplift their investment in private markets, and we are dominant in private markets, and so there's a very big appetite to increase the holding in private markets from somewhere around 5% to something in the region of 15 to 20% over the coming years. And that's been very evident over the last 12, 18 months. And I think Larry Fink referenced that in his chairman's letter to his shareholders earlier this year, that private markets will become an increasingly important part of the holdings of a lot of these funds going forward. But also there's a very big appetite to do things in a digital form and in a tokenized form. And that's for two or three different reasons. There are different drivers, one of which is by tokenizing a fund or even tokenizing a share class within a fund. What you're then able to do is fractionalize that share class. And the impact that has is it lowers the barrier to entry. And so if you listen to some of the people that have done this already, what they've actually been able to do is they've been able to, Victor Young actually describes it from Hamilton Lane very well. He's been able to lower the barrier to entry, and that democratizes the fund so that you get a much broader audience investing, because suddenly that fund is accessible to a much broader community of investors than it would have been previously. So tokenizing and fractionalizing really widens the audience because it lowers the barrier to entry from anything that could be as large as $1 million down to as little as $5,000, right? So that's very different. The other two things that it does is by putting things on chain, you're able to broaden the accessibility to the fund. And so you're broadening your audience because you're decentralizing the distribution of the fund and making it available across a wider community. And the third thing is that you can then start to look at assets that sit outside of traditional capital markets. And that's true of a lot of private markets. So we have very significant assets under administration in private equity, in private credit, in venture capital, in real estate, in data center financing. There's a broad spectrum of asset types that sit outside of traditional mainstream capital markets that allow investors to have a much more diverse portfolio of investments. And if you look at the investors of the future, the sort of the Gen Zs and the Gen Ys that are now coming into a tremendous amount of wealth that's being passed down through the generations, around 85 trillion coming down through the generations over the coming 20 years, then their expectation of their portfolio is far more diverse than anything we would have experienced when I set my pension scheme up 25 years ago. So there's a number of reasons why tokenization is really important. It gives much broader access to the asset class coverage. It gives you a much greater reach in terms of the community that you're reaching with your assets as a fund manager, as an issuer effectively. And it also allows you to fractionalize to reduce that barrier to entry. And these are all really important factors which are sort of, if you like, meeting the increased expectation of the investors that are coming into the market today, who expect to have a lot more control, not only over the asset class coverage, but the composability. How do you manage 24/7, which was your other question? You're absolutely right. It is very likely that there have to be periodic, if you like, sort of halts in the process. So it might well be that certain issuers might choose to say, we're online 23.5/7, or whatever it is they choose, because there has to probably be, for most organizations, a period of say 30 minutes a day or whatever, where they reset their end of day before they start their next day. And there is actually, to be fair, a period around the middle of the night, sort of 3 a.m. to 5 a.m. UK time, where there is, I think most of the markets are closed. So there is a natural period during which most markets are closed anyway. But I suspect most people that are operating on a sort of follow the sun basis will probably choose to have their daily reset probably for say 30 minutes or 15 minutes, during the least active market conditions on a global basis. So it just depends on how you manage your middle and back office, really.
That's a really great point that there's already these natural resets
Yeah.
baked in. You mentioned data centers, especially with AI, that's huge. I was listening to a podcast where the CEO of Corda was talking about, they specialize in cap table management, and the host, Gary Vaynerchuk, was talking about the blockchain and how, do you think this is the way equity is going to be shared in the future, that everything's going to be tokenized and, it's going to be on the blockchain?
Yeah, so if you look at cap table, I mean blockchain if you think about that sort of that golden record, the unified golden record, or what we used to say in my old R3 days, what Bob and Alice, what I see is what you see. The wonderful thing about holding information on chain, particularly unified golden records, is there is only one version of the truth, and the reason that having a cap table on chain is very compelling is that as you move an asset from one owner, the asset owner, to the asset investor, you can immediately atomically update the cap table. And so instead of historically an asset changing hands in one application and then the cap table being managed in another application, and I dread to say, unfortunately, in many instances that was in the form of a spreadsheet outside of public listed markets. That was not in public listed markets, but the point is, on a blockchain, that record, the registry of the holders of the asset, is updated instantaneously as the asset moves from the asset holder to the asset investor. And so blockchain is very well suited to holding that record of ownership on an immutable basis. And as I say, everybody's looking at the same version of the truth. And so long as you've got the appropriate level of access and privacy layered on top of that, relative to the application you're working on, so that somebody can't just come along and change the ownership from one person to another in some sort of erroneous fashion, then actually blockchain, I think, is extremely well suited to things like cap table management. And in fact, in our nominee structure, we spend a lot of time, effectively representing the interests of Apex Nominee Services, represents the interests of many investors through its nominee service as a single entry into the fund, which is represented under our nominee service, but sitting behind that can be hundreds or thousands of investors. So I think it is a really good use for blockchain, both in terms of the registry, but also in terms of the instantaneous movement from one asset owner to another asset owner in terms of updating that registry.
I love that. You mentioned, regulations being really one of the key challenges over the last few years, and really getting to the technology that's always been there to the financial institutions that probably could use it the most. And then to your point, gives access and democratization across these, new asset classes. Obviously, we see what's happening in the US. What are your thoughts around regulations? Does this benefit an organization like yours that's used to being, under highly regulated circumstances, and now you just have to flip on the Genius Act, and you're like, hey, we know we follow these rules all the time in the traditional world. This is easier for us versus maybe a lot of these, crypto native companies that aren't used to this regulation are really struggling with some of the regulations.
Yeah, I mean, the regulations are absolutely vital. And if you actually look at the territories in which there's been the greatest level of progress in terms of innovation within blockchain and DLT, it's typically been the jurisdictions where the regulators have been very progressive. So if you think about Switzerland, which was the birthplace of crypto, apparently, I'm sure it was, but if you look at FINMA, which is the regulator in Switzerland, they are extremely progressive. I mean, Switzerland has been very progressive in its use of digital assets. It was the SDX went live with a fully fledged exchange and CSD on chain, and that's over 5 years now since they went live. If you look at SNB, Swiss National Bank, it started issuing wholesale CDBC on chain over a year ago. So where you get these jurisdictions that are very progressive from a regulatory perspective is where you tend to get these sort of nuclei of activity from an innovation perspective. And the same can be said if you look at, I mean, I'm picking on the UAE. The UAE has gone through phenomenal change. In 1 year, they passed no less than 41 legislative changes in 2022 to prepare themselves for wholesale CDBC and retail CDBC, which went live at the end of that year. I mean, that's an incredible lift to make 41 legislative changes in 1 year in preparation for launching central bank digital currency. They've now got stablecoin licensing, and that's been available now, and they've taken their first, and they've issued it to their first 4 customers. So you look at individual jurisdictions, and same can be said for Hong Kong, for Singapore, for Japan. One by one, these jurisdictions are coming online. Now, why the Genius Act was so important was because the US, by virtue of its power within financial systems globally, was always going to have a great deal of influence over other super regulators the world over. And so once we had the Genius Act, what I think that has done, and this, you can see that here in the United Kingdom, it's become a catalyst to move some of the other super regulators forward that had probably fallen a little bit behind the curve. And so we're seeing a lot of activity in other jurisdictions now. And I think a lot of them will fall in line off the back of the regulatory framework that's been introduced through the Genius Act. And then hopefully very soon we'll get the Clarity Act as well for digital assets. So that's good. There is still regulatory arbitrage because you've still got asymmetry between various jurisdictions. But I think that arbitrage will diminish over time, and it will make our lives a lot easier with respect to scaling up the use of blockchain and DLT based applications and use cases, because we won't have to pick our way through this sort of minefield of, well, we can deliver this service cross-border into this jurisdiction because their super regulator allows it, but we can't do it here. So if you look at some of the early stablecoin licensing, like the CBUAE with the dirham denominated stablecoin, as it stands today, you can be licensed as a financial institution with a dirham denominated stablecoin license, but you can't use it externally. So you can't use it, for example, for cross-border payments. Now, over time, that license will evolve, and I'm sure they will bring into play the use of that stablecoin for cross-border payments. But at the moment, we're picking our way through this sort of slight minefield of asymmetry between the various regulators. I think as that normalizes, then you'll start to see much more scale appear on a global basis. But the cash element is the thing that's really escalated it, being able to access licensed stablecoins so we can facilitate settlement, we can diffuse obligations that are being created on chain, particularly for things like delivery versus payment, and for things like movement of collateral, as well as a secondary market use case. These are really important because they deliver real value in a real world scenario.
It's interesting. If you've been around this industry long enough, especially with R3, if there was a critic or a skeptic that was severely against stablecoins or even tokenization of assets, can you highlight or maybe Steelman, what the biggest argument they'll have in regards to this? I'm sure you faced a lot of these arguments within the industry that you've had to kind of maybe demystify a lot of people what this means. What's the biggest argument for someone that's against like the progression of digital assets that we're seeing in 2025 and beyond?
Yeah, so I think stable coins is a really interesting area, and I think there've been many critics who have been very vociferous in their views about stablecoin, not least of which was the Bank of England. I think many of those critics have seen that through the use of, so for example, we run a 24/7 stablecoin administration and operations service. We don't issue, but for issuers of stablecoins, licensed stablecoins, we can operate them, we can administer them, we can manage the middle office and the treasury functions to ensure that the assets that back those coins remain in sync with the number of coins in circulation. So things like proof of reserve, really important. Being able to make sure that if I'm minting a certain number of stablecoins and I'm distributing that number of stablecoins, that the treasury assets that sit, or the fiat that sits in custody with a secure custodian, matches or is commensurate with the number of coins in circulation. So I think what we've been able to do is show through things like proof of reserve, through being able to implement policy over the top of blockchains, so we can actually control the circulation of things like stablecoins, and also privacy and security, by being able to prove those things exist and prove that we can operate in a way that allows us to control the circulation of those stablecoins, and arguably you could even control their use through programmability of the tokens. I think regulators have come to understand that actually stablecoins can be used in a very safe and highly regulated environment. They can be controlled in their distribution and in their usage. And I think as a result of that, we're seeing a number of the regulators that were very sort of stablecoin unfriendly become a lot more comfortable with the use of stablecoins. And we've seen that in the last few days with the Bank of England becoming much more open about the fact they're expecting to see stablecoins play an important part in our future. And I suspect we'll see that happen here through things like the Digital Securities Sandbox embracing the use of stablecoins for securities settlement in 2026. So I think stablecoins have probably been provoked the strongest reaction. Now, where do we go with yield-bearing stablecoins? That would be very interesting, and that will be the next battleground, is what do we do with yield-bearing stablecoins? It is coming. I mean, there are already super regulators that have published regulations around yield. I mean, look at Bermuda. Okay, they already have a yield-bearing stablecoin. So so yield-bearing stablecoins will come. They're literally just around the corner in a number of jurisdictions, and I think it's all about putting the right level of regulation and legislation around them, and making sure that the technology and the operate model is commensurate with that and can meet those obligations. And so what we're doing every day is we're thinking about, from an Apex perspective and in delivering operations and services, can we meet that constantly changing landscape of obligations that our customers have to meet as in being an issuer of a licensed stablecoin. So I think it's a really interesting part of the market, and I think we've seen tremendous change. In fact, we've seen complete U-turns in super regulators who were very, very against the use of them, but now recognize that outside of the world of CDBC, which isn't going to be here for a number of years in many jurisdictions, stablecoins, if backed appropriately by cash or cash equivalent type instruments like high quality liquid assets, has a very important role to play. So I think it's going to be a massive growth area.
As someone that runs and has put a new meaning to SaaS, right? Stablecoins as a service.
Yeah.
I'm curious, when you talk about stablecoin issuers, like how many of them are coming? Like, I think when people think about stablecoins, they think of like Tether, Circle, and maybe PayPal has one. Like, they think of a couple. How many stablecoin issuers are coming to you? Is it like one, two? Is it like everyone's coming up with their version of a stablecoin for their ecosystem? Can you give us an idea of what you're dealing with from there? And is there anything that, if you are looking to get into stablecoins, it's not as easy as just saying, hey, we offer USDC or USDT or USAT. What are some of the considerations that you work on with these companies that make sure that to the requirements that you're talking about, that they might not be thinking about right now? They just want to catch the hype of stablecoins.
Yeah, so I think there will be quite a large number of stablecoin issuers. I think any organization that's got a significant treasury operation and is facilitating the movement of payments or cash, either inter-entity or intra-entity on a global basis, probably has a very good motivation for wanting to license a stablecoin. So I definitely think you'll see a large number of financial institutions, either individually or in a collaborative form, come together to license stablecoins. And I think actually we're seeing a number of banks come together and financial institutions come together to launch things like euro-denominated stablecoins. I mean, you'll see them in jurisdictions or in groups of financial institutions who between themselves want to be able to operate a stablecoin so they can move value between the walls of their own organizations and with each other 24/7. But anybody who has a significant treasury operation, I think, is likely to want to apply for a stablecoin license in probably more than one jurisdiction. And again, the other obvious candidates for stablecoins are global payment providers, payment service providers. Again, I think that's another big area where stablecoin licensing becomes very obvious, because you've got a frictionless movement of cash on a global basis where applicable and 24/7. So I think a lot of the big payment service providers, the very, very large corporate treasuries, and the larger of the financial institutions where they're moving very significant value either into entity or intra-entity with their larger corporate customers. So I think it will run into potentially hundreds on a global basis. I think we will in certain areas coalesce around collaboration in certain jurisdictions and around certain currencies. But I think the thing that will prevail is a consistent model where those stable coins, particularly in licensed stable coins, will, in their backing, it will always be either fiat or a combination of fiat and high quality liquid assets. So what we call cash and cash equivalent type instruments. And that's really in order to give, a safe, stable, stable coins, right? They're stable by their very nature. They have to be backed by stable or high quality assets. So I think that will be a consistent model where it's backed by cash or cash equivalent type instruments.
If I'm listening to this and, I'm a fund manager or administrator and this is all exciting and I have traditional financial products, what's the fastest like proof of value from
Yeah.
Apex Digital 3.0 that I could probably run in the next 90? Like I come to you and I say, hey, Angie, I want to do something with you. What's the quickest way, the time to fund, TTF? What's the time to fund? What is that version for your organization? What is the time to get, potential customer excited and using your platform right off the bat?
Yeah, so the platform's built, it's already live. So, I mean, we typically say that somebody coming to us with a new money market fund, for example, we've got quite a lot of inbound on money market funds at the moment. We normally say from the point that we have that very first conversation, particularly for an existing customer where we've already onboarded them, so we haven't got to go through the onboarding process with them as an entity, and there's plenty of them, there's obviously a large number of existing customers, then we normally say to get to the point of launching, as long as they are ready to launch at the point that we've actually onboarded the fund. Typically, we talk in the region of around 3 months, no more than 3 months, and it would be very rare for it to be anything much more than that. Maybe if they weren't quite ready, you could go a few more weeks after that. But typically, the process of getting from the initial conversation, and as long as the fund itself has been identified in terms of its construct, then we'd normally say within 3 months we can have that launched and out to the market. Now that's probably slightly elongated if it's not an existing client of Apex, because we have to go through onboarding and KYC and AML just like any other licensed regulated organization. But if it's an existing customer, it's very, very quick time to market. And in terms of the value, you think about a lot of customers they're sitting on, money market funds are a really good example, okay? A lot of stable coins are backed by money market funds. And now we've got a very large number of customers who are sitting on traditional money market funds. If we tokenize those money market funds, we can then make them available for stablecoin operators to use as the collateral that backs the stablecoin. So instead of the money market fund just sitting there earning yield based on the fact that it is a money market fund, we're now reusing that into a secondary market use case, because we're using it either to post collateral to another counterparty or multiple counterparties, or we're using it to back a stable coin, which is going to go off and facilitate some settlement or payment objective elsewhere. And so it's getting a second, it's earning yield in not just by virtue of the underlying assets within the money market fund itself, it's earning a second level of yield through being used as a payment mechanism in the form of
I think people listening to that are like, yes, we do have a fund here that's just collecting dust. Has yield gotten a bad stigma? I know in crypto, we're still recovering from Anchor and what happened with Terra Luna. Does yield still have a stigma to it in your side of the world in digital assets and traditional financial institutions? Or is it more common that people are like, yeah, we understand yield, we understand things like staking and protocol yield, how and people use the word like wallet and address and crypto very interchangeably. How is yield pervade in your industry, and how do you kind of communicate that to customers?
So yield is, obviously yield relates to the assets you're working with and what you're going to do with them. And I'm not going to talk about staking because I think that's a long way away from where a lot of financial institutions are today with respect to what they're going to be doing with their clients' assets. But I do think if you think about tokenizing something like, the reason money market funds and fixed income funds are interesting is because they are relatively high quality assets. They're fairly liquid. Money market fund in particular is extremely liquid and it's a high velocity type instrument. And the reason that being able to take that and tokenize that is so powerful is because you open up a whole world of secondary market use cases. Now that could be using it for unsecured financing, which brings a yield, right? It could be I'm using it to post margin. I'm lending it to another financial institution so that they can post margin, and they're going to pay me for borrowing that tokenized money market fund for 4 hours or 8 hours or 4 days, and I'm going to get the benefit of that on top of the yield that the underlying produces in its own right. Or it could be I'm lending it to a stablecoin issuer, and they're going to use that to facilitate payment, and that could be like on a rolling 90-day or whatever it is they're doing. So these secondary market use cases and the yield that we get from these secondary market use cases is incredibly compelling, and there is no real disadvantage to not doing it. Now, coming back the other way, the reason that's incredibly important is if you actually look at the investors of the future. So a lot of the asset managers are looking at what are the investors of the future. The average age of a pension fund holder is probably something like, I don't know, for somebody like a BlackRock or one of the large asset managers, is probably somebody well into their 40s and maybe even into their 50s. We realize that the investors of the future are different. There's a huge transfer of wealth happening in the coming 2 decades. 85 trillion of wealth is going to be passed down through the generations over the next 20 years. It's the biggest transfer of wealth between generations ever on record at all. And so the investors are going to be in a position to start investing much earlier in their life. So we have to think about what tools and in what way can we attract the investors of the future. And generally speaking, and I'm just using my son as an example because he day trades whilst in his 4th year at university, and thinks nothing. He's got, he works on 2 or 3 different day trading platforms and really is interested in nothing that's got a yield beneath 10%, which is quite interesting. So that wipes out most of the bond market. These people expect a much higher yield. And the reason that's important is because you have to, if we want to attract these the investors of the futures, the Gen Zs and the Gen Ys, not only have we got to give them composability and a more diverse range of assets to invest in, but also we've got to be able to allow them to improve the yields. And the only way you can do that is by being able to leverage these sort of secondary use cases. So I think it's really important. People's expectations of what yield they're getting have gone up as the age of the investor goes down. There is a huge amount of wealth passing down to those generations now, and we have to provide much more flexible use cases and much more effective use of those assets in order to get to those yields. And that's why tokenizing them and making them accessible to secondary market use cases like staking, like unsecured lending, like margin posting, collateral mobility. These are all the ways in which we can start to push the yield up on traditional assets in a way that will hopefully negate the need to get too much exposure to assets that are less well known or a little less stable, basically. So yield is a very important part of what we do, and we have to think about how do we improve the yield without necessarily increasing the risk of the assets we invest in.
Which is the ultimate dilemma in financial products, right?
Or spread
Increase
the
yield, decrease risk. And then anyone that says they do it too much is like, hey, how is that possible? I'm curious though, you mentioned a couple of things. You mentioned your son. Is there any assets that you don't think should be on chain, or anything that you don't think it's viable to tokenize? And is there any asset classes or just, financial products that you're surprised people aren't rushing to tokenize that, still slow to gain traction?
Do I think there's any assets that shouldn't be on chain? I guess the only assets that probably won't necessarily effectively be a front to back life cycle managed on chain are where you get a very, very high velocity. So if you look at traditional FX markets, for example, I mean, blockchain isn't famous for its speed. Its value is in the immutability and the fact that it's decentralized and therefore it can reach a very broad audience. But actually there are certain types of financial instruments that wouldn't, I don't think necessarily, certainly in the front office and at a trading level, suit blockchain. And FX is a really good example. The FX markets are very, very high velocity. They're very time sensitive. So we're talking about milliseconds and in certain markets even less than that. And so transacting on-chain is not really an option for FX markets, highly liquid markets. Equities, if you think about listed publicly listed companies, FTSE 100, these markets, again, particularly if you get into high frequency trading, you're having to trade in microseconds. That's really not the domain of blockchain. So I think there are certain asset classes that actually trade, certainly in pre-trade and at trade, are very efficient within their existing infrastructures, financial market infrastructures, like central limit order books, for example, for equities, and like the FX markets as they exist today. They're very fast moving. I don't think you'll see them on chain at an asset discovery and a trade level. Where I think blockchain comes in and is incredibly powerful is post trade. So if you think about they're not just, all the way from the match to the settle, you can actually collapse the whole life cycle of things like, if you think about OTC derivatives, which is a highly inefficient post-trade life cycle, you can actually collapse that onto the ledger and have it as a single unified workflow where there is only one version of the truth and it's on chain. It may take a few years for that to happen, but that's another big area where we can see vast improvement. But I think certainly if I go back to where we are, Apex, we see a broad range of asset classes that will come on chain. Funds is absolutely going to lead the charge for sure, because
Right.
the benefits are so enormous and the disadvantages are so few that transformation, and it is a transformation, it's not a revolution, it's an evolution, and a transformation has already started and is gaining scale really quickly. I think other asset classes for me that are really interesting are high value sort of commodities. So if you think about gold, palladium, platinum, all of these sort of very large, very valuable commodities where we want to monitor the entire life cycle, all the way from the initial mining through to the distribution, to ensure not only the origination is genuine, but also the quality of the assets and the transfer of ownership from the originator to the consumer has an appropriate life cycle. And we can then eliminate things like dilution of the assets and corruption and slave labor and things like that. So I think for certain commodities, it's very, very suited to blockchain and tokenization. And I actually think the bond markets still have the capacity to move wholesale, other than the secondary markets. I think certainly the primary markets could move wholesale on chain over time, but that requires regulatory change to allow us to hold the registry in a decentralized form, and that's not there yet for securities. But if you look at bonds, the origination of bonds in the primary market are incredibly well suited to smart contracts and the use of the ledger, not just for the initial instantiation of the smart contract, but also for driving the obligations of that bond over its life cycle, so that you can automate many of the actions and the events associated with it. But that will take a lot longer, because you're in the securities market, and it is, of course, as you know, very highly regulated, and certainly at a registry level through CSDs. The registry of ownership is typically centralized through a securities depository, and I don't think we'll see decentralized registries wholesale on a global basis for a number of years.
You raised some interesting points, especially about being in the securities markets, which is heavily revolved around disclosures. I'm hoping that we can use AI to make disclosures more fun,
Yeah.
more innovative, like maybe give it to me in a rap or a cartoon, because nobody's reading them anyway, and there's such a pivotal, pillar of having a securities. I'm curious, you just hosted Apex Invest in September, with speakers from Coinbase, 21X, Transform Ventures. You even had Ray Lewis there. I'm a big football fan, so can you give me some key themes or takeaways from that event?
Yeah, I was absolutely blown away by the diversity, actually, of the use cases that we saw through Apex Invest. We've got another one coming up in Abu Dhabi in November. I'm really excited to see what comes out of that particular meetup. We had a very diverse community. What was very evident was that many of the people that presented at Apex Invest in Lausanne recently had been in the game, had been innovating in the blockchain space for many years. And so the thing that resonated across many of those presentations was the unlocking of cash on chain. And what many people said was exactly what we've witnessed ourselves at Apex in Apex Digital, is by being able to finally be able to get cash in a tokenized form, in a regulated and licensed form, on chain, with all of the rigor and the governance that sits around that, particularly with being able to control the minting and the distribution and the proof of reserve, and keeping that consumer confidence strong, has really helped them with the confidence of their investors in wanting to consume funds that are in a tokenized form. So there was a theme that sort of ran through the middle of many of those presentations, and I was particularly blown away by Anthony Basili on the Coinbase presentation, because they have been so innovative, and they've got such an impressive client base, and the clients of Apex, we look after them in a number of areas, but and we're clients of theirs as well, actually. But I mean, it cuts both ways. But there was some really innovative work that's been going on, and people thinking about how do we, it's back to the yield conversation, how do we give our customers a better yield? How do we improve the quality of the service we deliver to them? How do we diversify the asset class coverage? How do we diversify their composability and their use of our wallets and things like that? So he talked about the vision of the future, and I have to say I was very impressed by that. I witnessed a panel yesterday at the Digital Asset Week, and one thing that really resonated was Sandy Call at Franklin Templeton said, if you think about where the market's going, really the whole account-based model that we've lived with, well, certainly all my life, all my adult life, financial services have been very account-based as an industry, is going to become a wallet-based industry. And I actually thought that was an incredibly insightful comment, because she's absolutely right. If you look at where you know, the certainly my children and Gen Zs and Gen Ys and millennials are going, you know, we surpassed brokerage accounts with wallets 3 years ago in North America. I mean, there are more wallets than there have ever been brokerage accounts in living history, and so it will become a wallet-based economy, and that's very interesting. And so long as we have rigor around the quality and the security and the privacy of those wallet providers, and that market is regulated, then I think we're going to see quite a big transformation in the way that people invest and the way they hold their investments and manage them over time.
And I think that transparency is kind of cool. Like, if I know that this is Angie Walker's wallet, I know what kind of NFTs you like, what, you know, companies that you're investing in from a digital asset. It opens up a whole new lens, especially in this social media transparency age where people can see what you're doing. If you choose to allow that, I think it opens up a whole new ecosystem of just, you know, not just traditional financial institutions where nobody can see behind the scenes what's going on. It really does have that kind of public nature to it. I usually ask my guest, Angie, about what books they read or podcasts they listen to. After listening to you for 50 minutes, I'm wondering, like, where's your book? When's your podcast coming out? Because I could listen to you all day. Is there any thoughts about, you know, creating your own podcast or your own book around some of these key concepts, since you have so much vast knowledge of the traditional and the digital asset space?
No, I don't think so, because I don't actually have time to listen to any podcasts, which is a real shame, because actually where I get an enormous amount of my information is actually just witnessing other people speaking about their experience, right? But I think the one thing I do try really hard to read as much of as I can is any of the publications that come from the super regulators. You know, whether that's consultation papers, or whether that's, you know, the publication of regulations and technical standards as they are, like the RTS type publications. I try to read as many of the publications that come from the super regulators as I can, and I also try to just keep on top of where organizations that do have a big impact on us as an industry and how we innovate, like the BIS, for example, and people like UK Finance and the Bank of England. I try to be aware of what's happening at a local level with respect to innovation and sandboxes. Some of these sandboxes are really important. If you look at the digital securities sandbox and what we can achieve with that, and things like the EU pilot regime, you know, these are dropping the life cycle into a single workflow. So we, you know, in the old days, we'd have a financial market infrastructure like an MTF or a regulated exchange, and then alongside that we'd have a CSD regulated under CSDR. Today, if you look in the DSS, or if you look in the EU pilot regime, and we've got customers like 21X who are operating under the pilot regime and regulated by BaFin in Germany, you can now trade and settle in a single workflow for securities. I mean, you couldn't do that before. You had to, in order to trade and settle securities, you had to have an exchange and a CSD. And they're very big pieces of infrastructure in their own right. So this is transformational. If you look at these organizations that are licensing under what was the UK Sandbox, which is now the Digital Security Sandbox, and the EU pilot regime, they are effectively facilitating the entire workflow of, you know, trading and settling and holding custody on a single ledger. And that's really important because that shows you where the market is going. And if we get to a point next year where I think we will get to where a digital security sandbox accepts stablecoins for settlement, instead of having to use central bank digital currency or connecting into RTGS, then what will be very interesting will be to see how we can then start facilitating security settlement using licensed stablecoins, because that really breaks open the door in terms of the whole industry. So I think there's a lot of things happening, but I do think these sandboxes, these regulatory sandboxes, are very important because they act almost as pioneers. They set they lay down the ground rules, or they sort of set the scene on what is achievable, whilst remaining inside the boundaries of what the regulators are expecting us to do. And MAS in Singapore, the Monetary Authority of Singapore, has been absolutely pioneering with all of the work that they've done through Project Guardian over the last 3 years. Again, very much pioneering in the way that they've been, and embracing their members to help take them on the journey as well. So, and it's not just securities, they've done it with funds, they've done it with other instrument types as well. So I think the super regulators have a big role to play. Industry bodies like the BIS, the Bank of International Settlements, have got a massive role to play. They represent the central banks the world over, right? And these organizations can help the rest of the industry to become regulated and to become educated and understand with confidence how you can use technology to achieve, very valuable outcomes without compromise to your obligations or to your client base. So I think there's a big role that is played by these organizations, and we need to support that, and we need to be part of that. And in fact, Apex is very active in its support of any of those types of sandboxes. And I think that has to continue to prevail.
And those sandboxes are, it's funny, you've probably seen many in the early days and what it's amounted to in regards to fair regulations, where the industry is actually able to put input, not just in writing, but be there at the table having real discussions, providing real life scenarios and examples. It's a little bit different than sending out a consultation and then receiving all these documents come in and all these revision requests, where when you're at the same table, you can probably communicate a lot easier. Angie, this was an amazing conversation. Where can people find you? I know you don't want to come out with your own book or podcast, but where can people find you to hear more of your thoughts and be inspired by this podcast?
Yeah, well, I'm available at Apex. You can reach me at any time, night or day. I can't guarantee that I'll answer 24/7 because I'm a human being, and I do sleep for a few hours, but not many, every night. But you're very welcome to contact me at any time. I'd be delighted, and we help, and we have a responsibility to make sure that our customers understand what we do, and to make sure that they understand that we are providing a secure, robust, industrialized operate model in the same way we do with the services that we've delivered for 20 years, right? So, we're continuing to maintain the same standards irrespective of what it is, the asset class that we're actually servicing. So it's important that people, when they do decide to do anything in a tokenized form, that they can come to us and feel confident they're not compromising on any of the obligations that they continue to meet as a regulated financial institution.
And I think anyone listening to this podcast will see what good hands and educated hands they would be in, just seeing your vast amounts of knowledge that you displayed in less than an hour. Angie Walker, thank you so much for joining the podcast.
Thanks, Stephen.